Markets bounce as the truce appears to hold between Israel and Iran. US stocks closed in on new all-time highs, and oil prices seem to have found a floor as a ceasefire in the Middle East seemed to be holding. Markets have their eye on both the NATO summit in The Hague and Fed Chair Jerome Powell, who continues testimony to Congress today after repeating on Tuesday that Fed cuts can wait. Kathleen Brooks is Research Director at XTB. Kathleen, despite huge geopolitical uncertainty this week, the market seems quite relaxed, doesn't it, even in oil?
Yes, absolutely. And I think it's all because of the oil market. I think traders, oil traders, stock traders, they've all been focused on oil supply, and that hasn't been touched in this conflict. So none of the retaliation or the US strikes or Iranian retaliation has had any impact on the supply of oil. In fact, oil supply and oil stocks have been rising in recent months and are expected to continue into next year. So that is the reason why, essentially that's the bigger picture for the oil market. That's why the oil price is very stable. And that is having a big knock-on effect elsewhere. It's helping to keep volatility low, and it's allowing stocks to really rally. And those themes that we saw before all of this tension erupted to really come back to the fore.
So does that mean oil markets have so much supply that conflict in the Middle East is just less important for the global market than it used to be?
Well, it's certainly a dampening factor at the moment. Oil supply is rising, so it's higher than it was last year, according to the IEA. So that's a real dampening impact. And I think, yes, there is a bit of a war premium, or there has been a war premium put on the price of crude oil. But as the tensions de-escalate and as we get this truce and we look at, the broader picture, it seems like it's a very short-term conflict, then I think that premium is really being eroded. So it's not the geopolitics doesn't matter, but you've just got to balance it against the key drivers for the oil price, which is supply and demand. And right now, the geopolitics isn't impacting the supply or the demand part. And there's lots of supply and demand is okay. But there's excess supply, if you like, and that's certainly keeping a lid on oil right now.
Are we still seeing moves into safe havens like gold, Kathleen, or is the market switching to risk-on mode?
Well, there's a bit of both, I would argue. Yes, gold has backed away from those highs, but it's certainly not fallen very sharply. Gold seems very firmly above that $3,000 level. It doesn't look like it's going back below that anytime soon. But then on the other hand, we've got the NASDAQ at record highs. So people are willing to hold on to gold, and they're willing to also buy, the mega cap tech stocks in the US. So we've got this kind of duality. And I think a lot of that is to do with the dollar, actually. People are buying gold instead of the dollar. The dollar remains very, very weak, or even though it had a little bit of a rally early on, it's falling alongside oil, really. And that's driving inflows into gold. And then I think there's just, there's so much dip buying going on in the stock market that it's hard it's hard to get in the way of the momentum, which is higher.
Crucial for dollar watchers, of course, is Fed Chair Jerome Powell, who insisted to Congress yesterday he's in no rush to ease borrowing costs, even though we know President Trump has made it very clear he wants a cut. What are you expecting from the Fed?
So we think that, his testimony today will be, very much more of the same. In fact, the testimony hasn't really differed much from last week's Fed meeting. So, from what we heard there, yes, they still seem very concerned. They've got to wait for tariff levels. But overall, there's a big expectation now that they will cut in September. So the market is expecting over an 80% chance of that rate cut coming in September. So I don't think there's anything to get in the way. We know that the economy is slowing quite sharply. Price pressures are, yes, it's not at 2%, the Fed's target rate, but they seem quite contained, especially with the oil price where it is. And so there's nothing really getting in the way. So it could be, a summer of fun for financial markets, because that's another reason to buy stocks.
With oil price worries easing, though, might tariffs come back as the market's number one concern?
Yes, I do agree with that. I think tariffs are there. We're 2 weeks away now from the deadline that President Trump set to get all those agreements in place, and he hasn't really got many at all. But the UK is the only one. So and everything that's going on with China. So we really will be looking for some frenetic action. We expect it to go right to the wire higher as always, but who's to say he's not going to kick that tariff can down the road again? You know, President Trump has a real habit of this. However, if that deadline expires and tariffs do go back to those very high rates that we saw in April, the markets aren't focused so much on geopolitical issues. They're focused on issues that impact the real economy, and tariffs do impact the real economy. So if we see them expire, tariffs go high again, that's when we could see risk off for financial markets.
That was Kathleen Brooks of XTB. Don't forget you can watch more videos on Reuters.com.